What if your employer made more money the day you died than any day you worked for them? Between 1993 and 1995, Wal-Mart bought life insurance policies on roughly 350,000 of its own employees. Not executives. Cashiers, stockers, warehouse workers, nearly everyone on the payroll long enough to qualify. Wal-Mart paid the premiums. Wal-Mart owned the policies. Wal-Mart collected the payout. It acquired a much uglier nickname: Dead Peasant Insurance. The Fifth Circuit itself would later note that Wal-Mart was only one of many companies running similar programs. But Wal-Mart's was the biggest, and the one that eventually blew the practice into public view. Here's the number that should stop you. The first 2 blocks of these policies alone cost Wal-Mart over $800 million in premiums. By the time they finished buying, the total ran past $1 billion. That's not pocket change spent hedging against a few key employees dying unexpectedly. That's an entire financial strategy built around the deaths of hourly workers who never asked for any of it. Employees could technically opt out. Fewer than 1% did. So why would a company spend $1 billion betting on the deaths of its own cashiers? Because the payout was never the real prize. Permanent life insurance policies build cash value the moment they're signed, while the person insured is still alive. But Wal-Mart's version was more specific than that. The premiums were largely funded through loans from the insurers themselves, and the interest on those loans generated tax deductions the company could claim year after year, whether anyone died or not. Wal-Mart's own filings described the plan's purpose plainly: tax benefits. The workers weren't being insured, they were being financed. One of those workers was Douglas Sims. He'd been with Wal-Mart for over a decade, an hourly associate, nothing more. Wal-Mart took out a policy on his life in December 1993. Sims never chose it, never benefited from it, and by most accounts never fully understood what it meant. When he died in December 1998, that policy paid Wal-Mart, not his family. His estate sued, arguing Wal-Mart had no legitimate financial stake in whether Douglas Sims lived or died. In 2004, the Fifth Circuit agreed. Under Texas law, an employer has no insurable interest in an ordinary worker's life. Wal-Mart lost that part of the case, and the dispute went back to the district court. By then, the company was already unwinding the program. Congress had gutted the tax benefits in 1996. The IRS came after Wal-Mart directly, and in 2002 the company settled, reportedly losing money on a scheme that was supposed to print it. $1 billion tax strategy, wrapped around the lives of its own employees, had turned into a liability instead. You'd think that would end the practice. It didn't. It just got fenced in. In 2006, Congress required employers to notify workers and get their consent before insuring their lives, and sharply narrowed which policies could still get the old tax treatment. The mass, unconsented version aimed at rank-and-file workers mostly disappeared, but the underlying instrument never did. Banks still hold a close cousin of it today, openly, on their own balance sheets. Bank-owned life insurance, still funding employee benefits, still treated as a tax-advantaged asset, still largely invisible to the customers whose deposits sit at the same institution. The outrage always lands on the wrong detail. It isn't shocking that a company can profit from an employee's death. Insurance always pays somebody. What should actually bother you is what came before the death. For years, an ordinary worker's life was converted into collateral without their knowledge, sitting on a balance sheet, generating value whether they showed up for their shift, got sick, or died. Your paycheck was never the only way you were worth something to your employer. Sometimes you were worth more as a line item than as an employee actually doing the job.
This is ScratchTheNomics.